In this video, we're going to take a look at the market for loanable funds and see explicitly how it's through markets that borrowers and savers come together. Now, in this particular video, we're going to make the assumption that we are in a closed economy. So that means the amount of net exports is assumed to be zero. And earlier we showed that in the closed economy, the amount of national savings will be equal to the amount of investment. So this is the fundamental assumption that we're making as we work through this market for loanable funds. Now let's start by talking about the demand for loanable funds. The people who demand the loanable funds are your borrowers. So in one simple case, you can assume who's doing the borrowing. It's firms. Firms want to borrow for investment purposes. You would also have governments. Governments may want to borrow to fund their debt or to fund government purchases. So in this market for loanable funds, it's borrowers who are demanding the funds. So let's go ahead and draw the demand curve for loanable funds. So here I have interest rates that are on the y-axis, and the quantity of loanable funds, or of course that would just be the amount of borrowing on the x-axis. The interest rate represents the cost of borrowing. So whenever you want to borrow money, you're going to have to pay something to borrow that money. And the amount that you pay is referred to the interest rate. So for instance, if the interest rate is 10% and you are borrowing $1, what's expected to happen when you repay this loan? And let's suppose that's an annual interest rate at 10%. When you repay that loan 1 year from now, you will have to pay repay the initial dollar that you borrowed plus the fee, which is 10% of what you borrowed, or 10 cents. So the interest rate is the cost of borrowing. Now, given the interest rate and the amount that you want to borrow, there's an inverse relationship. The demand for borrowing, or the quantity of loanable funds demanded, is inversely related to the interest rate. At higher interest rates, firms will not want to borrow as much money. If the interest rate falls, we see that the firms or the government is willing to borrow more money. So a change in the interest rate will be represented by a movement along the demand curve. If something happens that will give the borrower the incentive to borrow more money at each and every interest rate, then you would have an increase in demand. So for instance, if the government passed a policy that said for every dollar you borrow, you can write off 50% from your taxes. So we're going to give you a tax break. So if you borrow $1 million and we're going to allow you to write off 50% of what you borrow, that means you can reduce your tax liability by $500,000. So what that means is that at any given interest rate, the firms will want to borrow more. And so there would be an increase in the demand for loanable funds. Of course, if that investment tax break is repealed or removed, then you would just have a decrease in the demand for loanable funds. Now on the other side of the market would be the supply of loanable funds. And the people doing the supplying here would be your savers. So the supply or the source of loanable funds comes from savers. Difference rate, savings is the difference between your income and what you consume. Now, in the market for loanable funds, the savings or supply for loanable funds is going to be an upward sloping function. Again, why is it upward sloping? It's showing that as the interest rate increases, the quantity of loanable funds supplied, or the quantity of savings, is going to increase. Now, why do we put interest rate on this axis? We put interest rate on that axis because that is the price that the saver receives when they lend money to another. So in the earlier example, we talked about if you borrow $1, you're going to have to pay 10 cents back a year from now. In this case, who's receiving the 10 cents? The person who lent you, the person who supplied the money to you. In this market for loanable funds, the supply comes from savers. You can also think of them as the lenders. And what we see is that at very low interest rates, the quantity of loanable funds supplied is going to be relatively lower than what that quantity of loanable funds would be at a higher interest rate. So in other words, at a higher interest rate, the quantity of loanable funds will increase. And the reason why people are willing and able to provide more savings as the interest rate goes up is because the opportunity cost of saving. The opportunity cost of saving is you could have consumed. And at higher interest rates, what you're looking at is that it's pretty expensive to consume. If you could earn an interest rate, let's say of 30 cents on every dollar that you save, that means that for every dollar you consume, the opportunity cost is that you could have had $1.30 a year from now. And so that's quite expensive to consume that dollar today, because you're looking at having 30% more a year from now. So you're not going to consume as much, which means you will save more. Similarly, at lower interest rates, if the interest rate was only, let's say, 2%, then what's the opportunity cost of consuming $1 today? You would have had $1.02 a year from now. That's a lower opportunity cost in terms of what you're giving up by consuming that dollar today. So that's why at a lower interest rate, the quantity of money supplied in the market for loanable funds or the quantity of savings is going to be much lower. Now, what sort of things will shift that supply curve? Anything that will affect your incentive to save. If you're willing and able to save more, then the supply curve will shift to the right. And an example of something that may encourage you to save more is that you have a brighter outlook on the future. In countries that are ravaged by disease and public health issues, what's the use of saving if your life expectancy is 40 years old? But if things improve and life expectancy increases to 65 or 70, then there is an incentive to save more. Another thing that might give you the incentive to save more is if there is a reduction in the tax on your savings. In the United States, for instance, any interest that you earn on your savings account is taxable. It's income. If we reduce that tax on your savings account, that means you get to keep more of your savings. And that would give you the incentive to save more at any given interest rate. So supply of savings has been introduced. The demand for savings has been introduced. Let's now see what happens when we put the two together. So in this graph here, we have the supply and the demand for loanable funds. The supply again comes from savers. The demand for loanable funds comes from the borrowers. And again, when you think of savers, you can also think of those as the lenders. So they're interacting together here in the market for loanable funds. And a well-functioning financial system will make sure that people who want to borrow at different interest rates will be matched up with people who are willing to lend them the money at those different interest rates. Now, in this market, like we said, we are assuming that we have a closed economy. So net exports is zero, which means that in equilibrium, the amount of savings is going to be equal to the amount of investment. Let's suppose we have an interest rate of 10%. Currently, given this interest rate, there is a surplus of loanable funds. We don't have to review the surplus. We know that all that means is that the quantity supplied exceeds the quantity demanded at the particular price. And so whenever we have a surplus, what will happen? The people who are providing the loanable funds, the savers, will be willing to lend their money at lower interest rates just to get somebody to borrow it. So the interest rate will fall, and as it falls, Firms will be willing and able to borrow more money. Of course, some people say that as that interest rate falls, it's not worth saving. I might as well consume it, until eventually we get to a point where everything is in equilibrium. And let's suppose that that occurs at an interest rate. Let's suppose that occurs at an interest rate of 6%. So at 6% interest, the quantity of savings, I went straight over to the supply curve, so the quantity of savings is going to be equal to, at 6%, the quantity of money demanded for investment purposes. So it's going to be equal to the investment. Notice we're satisfying this condition of what will hold in a closed economy. If the interest rate were below 6%, let's say the interest rate was 2%. At a 2% interest rate, the quantity of loanable funds supplied is less than the quantity of loanable funds demanded. And so what will happen here is that people want to borrow more than what is currently available. You have a shortage of loanable funds, and so the people who want to do the borrowing will start competing against each other. They'll be willing and able to pay higher interest rates in order to get their hands on these funds. So they'll start to bid up the interest rate. As the borrowers bid up the interest rate, some of them decide it's not worth doing this project. It's not worth doing the project because the cost of the investment project is going to exceed my expected return. And we'll do some examples in class explaining how to figure out whether it's worth doing a project or not. On the savings side, as the interest rate goes up, the opportunity cost of consumption increases, so you see more savings. So it's via the market, via the pressures between consumers, in this case borrowers competing against each other, that will drive interest rates up if the current interest rate is below the market equilibrium. And it's the competition amongst the savers who will drive interest rates down if we have an interest rate that is currently above the market equilibrium. In the next video, we'll talk about adjustments to equilibrium if there's a change in supply or demand.